Before we get started on the panel, I just have to say, wow, what a rice day, right? So just amazing what we've been able to do through rice and coffees over these last years. Okay, we're trying to get the mics going. While we're doing that, I have one new person on the panel that didn't speak, and so let Will introduce himself really quick.
Hello, hi. My name's William Wojciechowski. I am a 2001 PhD in statistics graduate from Rice University. David Scott was my advisor. I must admit is some of the best 4 years of my life being here. And let's see, I think I spoke at the very first CoFES conference. And so from there, so for the past 21 years, I've worked in various capacities for quantitative finance, and currently I'm with Von Nelson Investment Management, which has been around in Houston since the 70s, and I am currently the Chief Risk Officer.
I'm so glad that Will could join us, so please welcome him to our... Okay, and I think, all right, so there was one thing that Kim said when she was going to do this. She goes, they're all guys. So I didn't.
Give me the mic, you see it.
No, I wouldn't dare. But I think that, but bringing that up, I think that is one of the aspects of CoFES that we've accomplished in terms of diversification of the talent pool and over the years. And so that's something that I'm certainly proud of, proud of everyone that went through our program. So thank you each for contributing today. So, all right, so going back to the topic. So, zooming out a bit. So we've had a really wide diversity of talks today on different topics. And so let's try to take a look at the bigger picture. And I want to try to get an answer from everyone if we can. But what do you see sort of next in your domain? And Dexter, I'm going to ask you to go last and give us a perspective, because you're retired.
Right, so I can't talk about my next bridge tournament, right?
Well, I don't know. CoFES funded a poker game a week ago. Will, maybe we'll start with you. So what do you see next?
It's on? Okay, great. Well, first of all, I have to say that, the opinions and statements expressed by me are not those of my employer. I don't guarantee that they're mine either. But, so finance and quantitative finance are vast areas. And there's, as we've seen today, in even this small amount of time, we've talked about a very large number of topics. And so currently I'm in risk management, so I will talk about the small area that I am working in and what I have seen happening. And what I've seen happening really has just been in the past 2 years. And I think one of the most shocking things and things that I'm excited about are the number of tools and data sets that are very easily and readily available to people to get. Okay, so that in one hand is great, because a lot of people can use their data, they can come up with models, they can do whatever they want with it. But on the other hand, it isn't so great, because in this field, the more accessible data is, the less value it has. It has been mined out, it has been made, and the markets become efficient. So yes, I believe that markets are inefficient enough that you can make a profit, but they are also efficient enough that you have enough smart people in here, and we all look at the same thing, and we all are trying to make money, and eventually those things are going to be arbed out. So I think, one thing that would be interesting from academia is to see, as we get more of these tools and data sets readily available, and it's very easy to go out and just do amazing things. I'm just blown away with the last, tool that I saw. I mean, I was like, usually I'm just like, yeah, whatever, move on to the next, which I've, seen, I guess I've been where I've at for 15, 16 years. And until the past 2 years, I've finally seen something like just almost, blew my doors off. So that tells me that we are going to make markets more efficient, but at the same time, I think you're going to have a lot of people coming in that will be using AI, ML, statistics, and they don't really understand data, and they don't really understand the pitfalls here. So at the same time, they're going to create inefficiencies. So I think it's going to be very interesting to see which balance we get from that, and how people are going to be able to take advantage of what's happening with those new tools. And I think there's going to be a lot of exciting things to go forward. I think for the students that are listening to the conference today, I agreed with what Max Lee said, is that you will really need to be a great problem solver. You are going to have to be innovative and look at something and really be able to say, okay, this is when it's going to fail. Okay, from not only a mathematical and quantitative perspective, but also from the market that you're dealing with, and then also the markets that interact with that market too, and the connectivity. So I really look, I guess, in three things that are available. You kind of can divide this up: is the data, the interactiveness, which makes things easy to do with the tools, and then also the connectivity, how everything is connected, and how you're going to be able to draw that and understand, how is our other things in the quantitative finance realm connected to what I'm doing today, and how is that, going to really interplay and affect us. Thank you.
Wonderful answer, Will. Joseph?
I'd have to agree. I'd have to agree with that. I think that currently, at least in the NFT space, there is a significant need for tools, for tooling to analyze even return and risk profiles. And the amount of money that's in that market now is really screaming out the need for these tools for analysis. And I think for students who love AI, love data, I think blockchain and NFT space is really where you have an open market. Unlike traditional markets, the data, the transactions, they're all there, right? And there's just a need for analysis. And I think many players are looking for the right tools to analyze NFTs, blockchain, DeFi, the same way you can do traditional assets. So definitely agree. Same thing.
So do you see NFTs continuing to sort of ramp up and grow?
I really do. I think it's quite early. Maybe a year ago, NFTs have now since 2014. About a year ago, it was really more, just, oh, let's try this out. Now more mature players are coming in. A lot of brands are launching their own NFTs. There's a lot of value there. And I think people are now starting to shift more, okay, yes, NFTs are here to stay. How can we actually use these tools properly? How can we actually monetize them long term? And so you see a lot of new things like, generating yields, using NFT as collaterals. So I think that's a sign of maturity. The risk is without proper pricing and tools, we do run a potential that we'll see a repeat of what happened in 2008 with housing, because it was similar with, you have these prices that are outrageous and people are being lent money at such prices. We do run the risk with the amount of money that's in the NFTs and without the lack of tools to give proper insights, that we'll have that same problem happen in the future. So I think that that's something we should watch for.
Max?
I guess, from my space, outside of kind of what we went over in the presentation, holistically, there's probably alternatives come a bit more into vogue, especially as, cash becomes more expensive. And if you get, an environment where equities and private equity aren't as great, that people look, I think, for yield in ways that are a little more creative, a little more different. And so, I think that carries you forward for, the next 5 years, and that in the long run, it's not necessarily scalable to have that one person that covers one thing. And so how quantitative finance can be applied across a broader spectrum and sort of bring investment to the areas which, again, have been a little more esoteric will probably be, a great opportunity. And then, even longer term, I think that there's, personally, for whatever my opinion is, there is probably a very structural shift that I think will come to the sell side in terms of what it is that the role of the bank does in the global market spectrum. The current hierarchy where you have, desks that focus on small things, I think that it feels a little antiquated and maybe not as sort of adaptive. And again, personally, just my same disclaimer, it's my opinion, nothing to do with Bank of America. But I think that you start to see that there's a lot, there's room for a lot of efficiencies and sort of transitions into maybe moving to more of like liquidity offering, and then a structured transaction offering. And I think that, again, that kind of shifts in like what the problems are that are associated with it, and sort of how do you redo this industry that's been around for now very in vogue for 40 years, presents all opportunities, right? And if you can be innovative in that, it's just, the world is your oyster, I think, so.
All right. My opinion is we saw a lot of demand on alternative data in the quantitative financing. For example, in most of our model is basically from the fundamentals from the Bloomberg data of FactSet. Right now, I'm our team is looking at some alternative. Let's say the solar panel installed numbers from California, Texas. We analyze also the solar, the renewable, for example, solar panel penetration on the energy market. We can see from the residential solar panel installed on the roof by the Google map or some alternative data vendor provide the image that shows how much, like the month by month change, even like a quarterly change to see how fast this industry is growing. And also by some alternative data, we can see which shows company grow faster in such a market.
So, I think of the history of quantitative finance, and it's mostly been about trying to find small, statistically significant, frequent returns that can be used to drive a portfolio's return. And people are, all the speakers talked about different data sources, trying to integrate new learning techniques. But I almost think we might want to start like flipping the script and thinking instead about like identifying risk. Because a lot of these data sources, things happen infrequently. You take like the meme stocks, for example, right? And a lot of quant models got beat up really badly on that because they see something that looks overvalued, goes up, 100%. It's even way more overvalued, short it. Now it's going to be hard to build a model that, depends on like a Reddit forum, something happening that's never happened before, but it could be a flag to a system that says, this is in a data space that we've never been in before, a state space that we've never been in before. Let's de-risk. Let's, recognize the fact that this isn't in our in-sample or out-of-sample period. This is completely unknown.
I like that. A new state, and we're going to de-risk. Dexter, over.
Well, I'm going to use my unique platform as the retired person here to pour some cold water on things. But before I do that, I'd like to say you were incredibly kind to the quantitative funds by saying that meme stocks sort of took them by surprise. Yeah. Oh, man. I mean, they just got hammered. You cannot apply models, based on logic and reason to something that has neither. And the most remarkable thing about that experience from the hedge funds that I followed who were into this is that they just kept trying. They just said, oh no, our models are adaptive. They've got this knocked. Yeah, no, did not work out well. Yes, let's all be cognizant of the things that can go wrong. Hey, has anybody used a product, maybe Google has one, but Babelfish, like, you just speak English into it, but you can, say, all right, Portuguese, and out it comes for the Portuguese waiter.
When I was in Brazil.
Yeah, well, those are all come out of a lot of research that Google did in their n-grams and words that tend to follow other words. It has no idea what it's saying. And it's right 99% of the time. Well, of course it is, because it's all based on the commonly said things. But man, when it's wrong, It is so spectacularly wrong. Yeah, so this whole idea of natural language processing, I'm looking forward to seeing how that works out. Anyway, a point I wanted to make about data, because a lot of us here today are data scientists, and we've got these fantastic tools, and we just want more data, better data, visible data, transparent data. The parties that create data, and by that I mean a buyer and a seller in a transaction, many times don't want the data to be public. They don't want it to be public. And Joseph, when you were referring to the fact that there are these NFT transfers, which I hadn't been aware of, but I can certainly understand why, because it's a way to get something to its new owner without the public figuring out what it was worth. I had to make this point to the
Don't they have to tell the IRS at least?
That's it, right,
Yeah,
thank you.
Sorry.
Topic for another day. When Dodd-Frank rules were being proposed and CFTC was taking comments, I remember making this point both to CFTC and to the SEC. Look, if you're talking about the prices on publicly traded stocks or the most liquid bonds, who cares? That's fine. Just report them, get them out there, get them fast, and the data scientists want it, and it's good for the market. But there are some very illiquid transactions, or you can take any asset. I don't care if you're talking about Apple stock. If you're talking about $1 billion worth of Apple stock, that becomes a special case where buyer and the seller, they don't want anybody to know that price until well after the dust is settled on that trade. Now, why is that? Because if you're the guy who has $1 billion and you've just decided you need to unload it, and now you're trying to figure out, well, what do I do? Do I do a secondary market offering? Do I find one bank who's willing to put a price on it and take it all off my hands? Do I work it over a weighted average price strategy over 30 days or something, however long it takes to get that much size done without affecting the market? Well, if somebody's willing to step up and take it off your hands at a price, and I think we could all agree it's going to be a pretty good discount from wherever the market is right now, that guy, now he's got the $1 billion problem. Because, if B of A decided to take that off his hands, you are not investors in Apple, right? You've got to have your own plan on the other end of that. So this $1 billion of stock is going to wind up someplace 30 days from now, and it's probably going to be many places. The buyer and the seller are the people with the least amount of motivation to have that trade made public. They just don't want it done. So I was trying to impress on them, that, and the problem at the CFTC was that at the time, Gary Gensler was in charge. Gary came out of Goldman, and Gary's view was, look, sunlight is good for all things. Well, it's not good for vampires, and it's also not good for these large illiquid trades where, if again, sorry to pick on B of A, but if B of A knows that everybody's going to understand $1 billion just traded, some bank is stuck with it, guess what's going to happen to the price? So B of A, not being idiots, they're going to say, oh, well, I'd like to pay you down a few percent, but because I have to report the trade, I can only pay you 10%, less than the current stock price. Well, who benefits from that? Doesn't help B of A, doesn't help the client. So I was just trying to make the point to the regulators, and PS, unsuccessfully, this did not go my way, but the only person I care about in a transaction like that is my client. It is literally my job to do the best I can for my client. And my client and I both agree that we don't want this transaction published, but you're saying that there's no way around that. Yes, because the public just needs to know. Well, no, they don't. They don't need to know. So listen, data scientists, sometimes you're just going to have a marketplace where the data you want aren't there, or the data points will be few. And that's where I'm going to say I love the comment you made, Max, which was that, when we're interviewing people, yeah, well, you need to communicate, but can you think outside the box? Can you build a model or have some intuition based on a few data points as opposed to 20 billion of them? Let's find those people.
So I just have to say, in our sort of broader research effort here at Rice, we have a pretty strong team thinking hard about synthetic data. And so maybe in financial markets, we don't think about synthetic data. So this is simulated data. So, but we think about it a lot when we're thinking about studying people. You know, can we come up with data that's close enough to use by data scientists to get their methods and models going, but it's, so it has the features that you need, but we're not giving away any data privacy issues. So thinking outside the box a little bit, is there a place for synthetic data or digital twins in the finance world? Something we think about elsewhere in science, but maybe not in finance.
Can you define synthetic data? I don't know what that means.
Fake data, fake news. No, so again, so if you think about you're studying people, and none of us want our personal information to be out in the world, but we can mimic a cohort of personal information. And so it's simulated data, but simulated in ways that mimic the population that it's studying, I guess. So that's not on Kim's list. So maybe I should back off of that one. Okay, well, go ahead. So.
Well, on company level, I know that simulated data is already used. So if you have a new company that's become public, but they don't have the history, you may go out and find a way to simulate the data to model how you think that company will behave similar to other companies. Now, for the people problem, that isn't something I've dealt with, but I think that what's very important when you do this is with any model is you certainly need to sit down and monitor that as you go forward and see, well, does this actually meet the reality and my expectations? I think that that is a common goal across all quantitative finance, whether you have real or simulated data. And I think that's probably where you get it. You know, how far are you from reality to that, and how well your model's going forward? I guess more you want to think about the predictive than whether or not this is modeling historically. And so I think that's actually an area of statistics that can be relatively new. We always fit our models to the historical data, but you know, you may want to have criteria where you fit your model to the predictiveness of your simulated data or real data instead of, you know, kind of the more classical type of model fitting. I think, well, actually, I think that's probably something that would work if, you know, from experience, that's really the direction you need to go. I think that was probably one of the problems when, I guess, quantitative hedge funds first came out. Okay, when people started doing this with LTCM and things like that, no one was really tuned in to monitoring going forward and saying, hey, look, we had all these characteristics from our back tests, but they really weren't monitoring going forward, saying, hey, look, now we're not even close to our back test for our performance, our volatility and everything. And guess what? Our model is saying we're going to zig, but the market zags, and that's where you get into trouble. So I think that analogy will be similar to using your simulated data. I think there's no problem with that, as long as I think that, well, certainly you are smart enough, but people that have access to these new tools and they go read the $10 book from Amazon on AI and ML, they may not truly grasp the fullness of what they're doing with that type of data.
And notice that I strategically moved from using the word simulated to the word synthetic. So
Yes,
that was by
sorry.
design, actually. Okay, so moving on to, okay, go ahead, yeah.
No.
Okay, great. Okay, oh, good. Oh, dear. Maybe I need to duck behind the podium.
You know, early on when I joined PDT, they had started to recognize they were no good at discretionary trading. And they had started keeping a log of every time they decided to override the model and what the performance of that strategy was. And it had like a negative 50% annualized return with a -3 Sharpe ratio, so
So not good.
overriding the model, yeah, we weren't good discretionary traders. Now, there might be people that are good discretionary traders, but we were, a bunch of like electrical engineers and computer scientists and physicists who were trying to, be systematic about. But, it's there's these behavioral biases have been identified in people, loss aversion, the preference for lottery-like payouts. So could you design a simulated person that had those biases and create a crowd of those that interacted with market data
Yeah.
to see if you could find, manias and crashes and something that looked close to what happens in the world? It'd be interesting. I mean, it sounds like a very complicated research project, but
Well, what else do we have to do, right?
Well, we're thinking alike. So here's my idea for you.
I told you, Dexter, we couldn't come away with more ideas for Kathy. So,
Yeah.
so
Well,
it's the
Well,
universal
you put this thought in my head when you said long-term capital management, right? Because what happened in long-term? They had Nobel Prize winners who failed spectacularly because the market did something it hadn't done before. So you can do all the back testing you want with real data. It's never going to come up with the scenario that kills you. Every bank today undergoes stress tests conducted by the Fed. And the stress tests are secret and nobody really knows what is coming at them until the time comes, and then they say, okay, here's the scenario. The scenario is that this sector of the market does this and that one goes there, and you never know what's coming. It's always very extreme, and they just want to make sure that your bank's got enough capital to survive it, as unlikely as it may be. So your market, once you develop this product at CoFES with the coffee brand on it, is you sell this to the Fed, the controller of the currency,
I'm
whoever it
listening
has to
now.
be, to the bank regulators as, listen, we have the best synthetic data on things that have never happened before
We could probably pull that off, actually.
for your stress test.
For your
And
stress test.
yeah, because in fact, there should be a market for scenarios that could happen.
That's not a bad idea, actually. Wow, we came away with an idea. Okay, so getting that's really cool idea. Roxy, you want to help us? count you in. Okay, so thinking about risk. So we talked about a lot of emerging market opportunities, and so there's going to be natural risk associated with those. And Will, you actually think about risk on a regular basis. So what are some of the major risks people should be thinking about now? People like you and people more like us that hand you our money to do something with. So, okay.
Well, it looks like we're heading into we're already in high inflation, and we are heading into a very similar high inflation environment where Volcker did his thing. And if you believe what the Fed has been telling you, that's what they're going to do. That's the playbook that they're following. So if they actually go through with this, they're going to raise rates until they cause a recession. Okay, that's the only way they're going to be able to contain inflation, in my opinion. Because what we have done through COVID, and now we have also the war going on, is that we have destroyed the supply. Okay, so the Fed was able to get away with, from 2008 and on, with having low interest rates and not having high inflation, was because we have an overabundance of capacity. Okay, so one person goes out of business, money's cheap, easily available, next person comes in. So we never ever got to the point where we had undercapacity. However, now we had the shock from COVID, we have the shock of the war. The Fed can't just go type numbers in their book and print money to solve the problem. Okay, this is a physical constraint and it will not be solved overnight. Okay, I think the Fed realizes that, they know that. So they are going to have to somehow control what they can control, and that is the money and the interest rates. And the only way to, if they really want to kill inflation, well, they're going to have to kill the economy, because supply is going to be constrained in capacity for quite some time, since those are physical issues. That's not a vapor that you can just, throw money out of helicopters to solve the issue and to keep the game going. So I think the risk that you're going to have here is that now most people that managed through that time with Volcker are retired. They are done. They are out of the market. Okay, so a lot of the managers are not going to know what to do. So I think there's going to be a huge risk in terms of managers not really understanding at first what to do, particularly in fixed income. I probably would guess there's very, very few fixed income managers who manage through a rising interest rate environment. Okay, just if you don't believe that, just plot. See, but you're retired, right?
Are you coming back out of retirement?
Yeah, so if you just go plot the Fed's fund rate through time, you'll see that, you know, we've had small blips of rises in the rate, but the long-term trend is down. So everyone's had the easy game, you know, of just making money with the fixed income, whereas now it's going to be much more difficult if we actually start having to get into long-term rising rates to control inflation. So I think that's really where you're going to see a lot of mistakes made. So yes, I think for 401ks, you you may get hurt on that somewhat, but I think for actual managers, I think it's going to create a lot of opportunity for people, particularly people that are managing in hedge funds in the alternative space that can do things that other managers can't do. So my present recommendation is to prepare for the Fed creating a deflationary environment by raising the rates and killing the economy. That's where I think that the risk is right now for people.
On that really optimistic note.
Can I ask a question there?
Yeah.
You say raising rates and killing the economy like it's a bad thing.
That's what's bad about it, but you know, if you listen to people talk about it now, why are they following that playbook? Because they believed it worked. Obviously they have to trade, well, what's the worst outcome, right? And I'm going to have to pick the least worst outcome, and that's what they're going to have to do, because you just let inflation go rampant and then everyone's going to be affected by that. Whereas if we take out the economy a bit, then maybe we'll have some pockets here and there, and that I think is probably a lot easier for them to deal with than having rampant inflation.
Yeah, well, I think that's the key to the problem that they face. Inflation is a tax, right? It's just a tax on people on fixed incomes or people with little disposable income.
No, that I completely agree.
And
Yeah.
taking out the economy more broadly spreads that tax over a larger base, although it's still, unquestionably hits the poor harder.
I agree.
But that's a social policy question. But it isn't necessarily a bad thing. Just depends upon your social metric in place. And I'm sure the Fed has its own, and who the heck knows what it is. But that's traditional policy, is to say, look, it's better to have a recession than it is to have inflation.
So we have other panelists ready to jump. We may have some.
Can I ask?
Yeah. Okay.
So I have two thoughts on that I kind of want to ask everybody. Oh, sorry, Mark Radulovich, been coming to CoFES for, I don't know, long enough, where I keep coming back. No, it's you keep on having good arguments like this. So I get a question. We have more retired people. Well, one out of 6. So 15% of our audience here is retired. We have more retired people than we've ever had before, right? We have higher debt than we've ever had before. We have higher government debt than we've ever had before. And I want to throw an idea out there. I'm not saying I believe this. I'm just kind of as a thought experiment. If the government has 8.5% inflation, whatever the number is, and they're selling debt at 3%, that's a 5% carry trade. Many ways, I look at it and say, if you bankrupt retirees, you got a big problem. If everybody has to pay more for green beans, Yeah, they're going to complain and maybe you get kicked out of office and the other guy gets to have office for a little bit, but eventually that'll go away. And one of the things I look at is that frustrates me. I'm an RIA, so I own a company called Proto Financial. We do the Proto Challenge every year. And one of the things that frustrates me is that word, you use synthetic data. As soon as you said that word, I thought the word backtest. Because every backtest is synthetic data, right? It's a lie masquerading as truth. And so you know my opinion on that, sorry. So I'm getting to a question here, I promise. So I look at it, nobody does backtests in the stock market. I'm not going to name any names here, but I've worked with some of these firms that are sitting in front of us today. Nobody does backtests far enough to really look what happened, right? You see, most backtests that I see for funds go back a decade. The good ones go back to the early 2000s, right around the dot-com crisis, but before the financial crisis. Few go into the 90s, maybe the late 80s, right? If I go look up VFINX for the Vanguard S&P 500 fund on most places, I can get data back into the mid 80s, right? And maybe I can get data to 1970 for some things, 1955 for the S&P. I have no idea what happened in the teens or 100 years ago, 110 years ago. And just kind of want to get your thought as we have these set of managers. Technically, I am one, but I'm a skeptic. I hate the finance industry, which is why I come here, because I think you guys are trying to solve problems. And yes, I work in the industry I hate. So pardon that a bit of illogic there. What do you think is going to happen, given that we're faced with a situation we've never had before, never been documented, at least on this scale of 300 million people, with all the back testing, with all the people that have been in the industry who aren't retired, right, who haven't seen this sort of stuff? How do we solve that problem? We have a ton of very smart quants in the room. All you guys are smarter than me. How do we get to the other side of this, short of just stumbling through a room with the light off? It seems to me like we're not well equipped. There's a great Einstein quote that I can't remember, but the guy who created the problem isn't the guy who could solve the problem in a gist. How do we get through this from a quant perspective?
Wow, that's a challenging question. So it's
I'm retired.
So that means you're on fixed income. So, anybody take a stab? NFTs, they'll save the day. No, that's a very serious question.
I think we should buy. No, I don't have a solution, but I look at the problem from a different perspective. I think if we have a major recession, it'll affect the startup community significantly at this time. I know that for those who are trying to fundraise, there are whispers that funds will tighten very, very soon. And I think for emerging spaces like NFTs, blockchain, et cetera, I think that that's a risk that we're all looking at with what's going on. So as far as a solution, I mean, if we can have better models, that would be a start, because, that's, as a data scientist, that's some of the best tools that, you can try to build better models. That's really what I can think of, because absent of data-centric approaches to these things, you're really not, that much better than the ones who've caused problems in the past. So.
Mark, I think you've
I threw in a hand grenade.
yeah, well, but I don't.
I talk a little bit, because I don't know if you're serious or not, but I mean, backtesting is a very large part of our business. And, I think that there's, an issue with that. When we actually look very similarly, that some of the strategies, when I started, the kind of like the thematic point was, okay, go back to like the start of the dot-com, that's 2015. Now it's like, well, does it really matter, what the performance was, pre kind of GFC, especially in, if I think about like the commodity domain, where the evolution from 2000 to now, when you had people that were yelling in a pit, it doesn't really matter. So that's a tough one. But I tend to, and from what we've seen, have found that, depending on who you're marketing, right? If you're not marketing to, the average Joe that's looking to put their 401k somewhere, that there should be some understanding around the concept of what is, germane to the current environment, and that people can wait, or investors can wait if they're qualified, a quib or whatever it may be, to weigh, what they put relevance on. But then larger, I think, at least personal opinion to the problem is, I think that problem is different or has like a little bit of a bifurcation, in that if you are looking to help, the American economy, the American public, that I think I have no answer to that, right? That's, way beyond my scope. But in terms of, how do you make it through if you are looking to generate return? I mean, in theory, this should present, a massive opportunity, kind of like you said, right? And at the end of the day, the backtest is there, the data-driven strategies, whatever it is there to, in essence, like, you said, to model and provide, an expected outcome that, you think is true. And whether or not you decide to action that's kind of the job, right, of taking the risk. And so, I would think that, for everyone that's on the room that, either manages actively professionally, or at a fund, at a bank, whatever it is that you do, and your job is to, in essence, somehow come away with that and, be adaptable, and make as best informed decisions as you can. And that is a different problem, and I think one that's a little more solvable by the idea of, the synthetic data, maybe, whatever it may be, to come away with, versus, what is best for like the country. So that would be, my 2 cents on it, for whatever it's worth. I do think it's actually a really interesting point about the risks, though, because somebody said that, what FIC kind of manager has been around. I would have not been in a massive rate cycle, but I also, even if I go back and look at history, do you have in a large interest rate cycle somewhere where, the actual physical supply and sort of the supply chain issues are as prevalent as now? And so when I think about inflation, I think about what is the price of the good that's going up. A lot of those goods, if there's a true fundamental issue in the production, or in the supply of it, or it can't get anywhere, does, substantial interest rate rises actually tamper that price down? In a meaningful way, or is it, initially just off the cuff, send everything in a recession, people lose their jobs, and then once that's done, people realize, well, we still can't get wheat out of the Ukraine. Does that actually work? So I know that I think is kind of the thing that we've been most focused on, actually, is, everyone expects the rates are going to go up. What is the tail scenario that we think could happen if, in reality, that doesn't actually solve your true core demand, true core good problem? How can you capitalize on that? That's, different ethical question, but that is kind of one of the main risks that we see, around the whole issue. So,
Hey, panelists, can we all agree that we have no idea how to answer his question? Well, we don't know. Just to make it official, we don't know.
Right.
But so many people in this business call themselves quants, and I put that in quotes. I don't put you guys in that, because you guys understand that, right? So many people are in this industry, and they and that a back test or whatever is truth. And it was true at that particular time. But what I wonder is, as we move to too many thoughts in my head. The simple thing, market has a bad day, correlations. All the things that used to be uncorrelated start. It's not going to have a downside. So I got in. We have an investor. And my response was, I'm beating the market by 12% with that. That's the best investment I've seen in a while. Yeah. And it's a pause. Okay, yeah, that's good. And the conversations, right? We talk about other stuff. So what's interesting, though, is people aren't used to that, right? The call was, I am investing my money. So I can't find something that can do cash right. And I'm concerned when I see the talking heads on big channels, ABC or whatever, that the
Fed is to your point about Ukraine and wheat, that's, I just call it Ukraine, obviously. One of the things I look at is, yeah, you can crash the economy, but you said you still can't get wheat out of Ukraine. By the way, there's hard to buy wheat out of Russia right now. So you're going to have a ton of countries that are going to suffer from talking about this.
So I have a very hedge fund centric view of the world. And there are investment strategies, there's hedge funds in the macro category that attempt to trade off these trends. And typically they have the highest returns and also the worst returns because they're making very correlated, very concentrated bets on very few assets. I don't know how quantitative. I mean, I think some of them try to but like I said, the quant approach seems to work better just based on statistics with things where there's a lot of assets to diversify across. So I'm not sure we're the right audience to be asking about, sort of macroeconomic effects. I mean, none of us have, other than Dexter, have managed money in a rising interest rate environment. We had some periods in the 90s where, the Fed actually didn't keep interest rates zero for, years on years at a time. And it did cause volatility in the equity market. But we also had, good equity markets during that period as well. And I mean, the classical economics answer to your, the market's already priced in all this, right? It's an efficient market. It's been priced in. So, it can go either way from this point.
Yeah, and just for the audience online, so we were basically talking, are there any models that will help us model our way out of the impending crisis that we see? Is that a good paraphrase of your mark? Okay.
So look, I can't help you, but you seem like a troubled individual, so I'd like to try to at least make you feel a little better. First of all, 8% inflation, that's nothing. Come on, 8% inflation? When Jimmy Carter was president and Paul Volcker was trying to crack this problem, inflation was 17%, the prime rate was 21. Ginnie Mae issued a 17% coupon mortgage security. And so the underlying mortgage rates were 0.5% higher than that. The maximum rate on a treasury at that time was 15.25. Listen, we've seen a lot worse. Second thing I want to tell you is pick up annual reports from banks over the last 30 years or investment companies over the last 30 years. And you tell me what percentage of them start out with, well, the last year has been really challenging. We are seeing, this is unprecedented. Well, of course it's unprecedented. It's called the present. Right. Look, so these are challenging times. I remember talking in the late 1980s with our recruiting department about, man, we got to go out and recruit heavy because nobody at this firm knows anything but a rising rate environment. That's all we knew then.
Rising rate environment.
And now it's the other way around. So look, the point is we muddle through, right? We get there. I don't know how we're going to get there, and hopefully there will be some better model or some innovation, but it's not as bad as, at least on the inflation front, as we've seen. I wish a lot more of our attention would be turned toward, how to mitigate the damage that we're about to create in trying to fix things.
That's a good point. So, Michael, let me get you. Dr. Jackson.
Okay, so shifting the conversation back to crypto. So if everyone can answer this. So simple thumbs up if you've already invested in crypto. And if you haven't invested in crypto, what are you waiting for from the market to give you a signal that will indicate that it's investment grade in your mind? Thumbs up, thumbs down, or to the side. Yeah.
Were you using your own electricity?
I own no Bitcoin or any other type of cryptocurrency, and I really haven't investigated that much to do that. It's just not my area, so I haven't looked at it. But I do believe, at least from watching it near term, it's behaving, I guess, more like art in terms of being I guess, a wealthy asset in terms of it's going to do well when, interest rates are low, money's cheap, and people will have lots of money to spend on Picassos. Well, they have lots of money to go throw at Bitcoin, which is backed by nothing. And so I think that's what you're seeing now also. So it's not my area, but that's just my opinion on it.
Well, I'm clearly invested, so in more ways than one. But those who are not, for those who are not invested in crypto, I think, rather than trying to sell you on that, I think you should probably think about what makes the blockchain different from other services. What makes decentralized blockchain services different? And the way I think about it is, smart contracts, for you to be served, a smart contract doesn't really need to know where you're from, what your gender is, what language you speak, what religion, you adopt. It just needs to know your balance, right? So there's a certain level of access that it provides that you don't get from traditional services. And that's kind of how I think of it broadly. And that opens up a lot of new avenues that I think that we should all be paying attention to.
Yeah, my opinion on the cryptos, right now still a lot of people speculating on this space. So I'm waiting for less speculating and people utilize it for right things. Then I'm thinking about to put some investment on that.
There we go. I mean, I have a small amount. I mean, I think the reason why I've not put a larger notional or sort of larger allocation of my own money is that, I mostly invest in, like I said, in stocks for something that is a little more consistently of like a positive rate, right? I mean, the idea is I put my money there because I wanted to appreciate over the next 20 years. And as of now, I think, like I said, there's so much opportunity, like you said, for the space, but I don't think that it's proven that, it can generate a stable return per se. Like, I don't want necessarily money that's for, retirement in the future to be able to drop 50%. In a non-never spend way. And I think that's really it. And if it does though, and it takes on the behavior of more of an investment grade kind of asset, then does it still have the same attraction to the current crowd? And I don't know about that either. But personally, that's kind of the reason why, the percentages is still fairly low, at least from my perspective.
One more thing, I get a hard time to understand the Bitcoin mining thing. Humans spend so much energy on mining that thing and just competing each other. So that's the thing I don't understand.
Yeah, well, the environmentalist in me has a hard time with sort of the mining paradigm. I applaud you for being on your own ranch with your own solar panels. And so maybe if that was the case, that would be, but so we're creating more problems for ourselves beyond just finance, I think. So, but there are energy efficient mining methods, right? So we should be moving through that.
The Quebec power plant also is super efficient using hydro. If we're using natural resources, I think it's okay.
All right, very, very good, very good.
Kathy?
Yeah, go ahead,
So I
Dexter.
feel like the subtitle for Bitcoin mining should be, it's a tough job, but somebody's got to do it.
But someone doesn't have to do it.
Yeah.
It's a manufactured job, right?
Yeah, I said in my talk that I have never owned a digital currency. I still actually get hired to come talk to organizations about blockchain and Bitcoin and give advice, which is incredible because I gave advice to a firm on the West Coast who would definitely like not to be named, that there was just no rationale for them to buy Bitcoin. This was when it was at $300. And I firmly believe I was right. It just nowhere in their mandate could they have justified buying an asset with those characteristics. The fact that it went up by a factor of 100 is besides the point. But I think, Joseph, you hit the nail on the head when I hope you intended to, that the currencies and their underlying technology are two different things, right? So I don't care about the currencies, I just don't. And they'll come and go, and I have no ability to predict the winner, and I've demonstrated that. But I am a huge believer in the potential for the technology.
I have to say, I'm at the end of the month, I'm at a NSF sponsored workshop for sort of collaboration with our some federal agencies on blockchain. And so it's kind of interesting to see that side of things. So nothing to do with finance. Believe me, nothing to do with finance. I do want to, we probably need to close out pretty soon, but I want to ask one question just because it's, I think it's something that none of you have really hit on, and it keeps me up at night. Maybe it doesn't keep anybody else up at night. And that's sort of the cybersecurity, the grid issues, power issues. Do you worry? Is that a risk that you think about in terms of your modeling and your quantitative strategies and your new investments? So, all of a sudden you don't have the power to keep your computers get struck by lightning or something. So are these risks that y'all entertain, or is it something that is just irrelevant to the day-to-day?
It's a risk that I hope AWS entertains.
Yeah, well, AWS is probably does entertain, but it's an expensive option. So.
Right. Yeah, not directly, but
yeah.
But it's a risk. It's certainly something that affects everyone. Actually, so before we set up Meritic, we set up our own Ethereum nodes. We were using a service from a country that was based in Kazakhstan. And I think you recall, 3 months ago, they had an uprising out there. And during that period, I actually decided that we're going to set up our own Ethereum nodes because of that. So these issues like infrastructure issues is not something you want to deal with when you're trying to build on top of that stack. So power is something we just assume will always be there. And I think if we lose power, certainly, healthcare services would be the main concern for everyone, right?
What about the cybersecurity side of?
That's true. It's certainly something we should look and consider more.
Consider more. Yeah, sure. Yeah. David, sure. No need to be quiet.
No, I was around during the Jimmy Carter days, and I bought 3 bicycles. That was sort of I thought that was my great hedge. But I think, actually, there was something wonderful about 15, 20% inflation. It's sort of a less violent war, but there's so much deadwood in this economy, and nothing like shaking shaking it out with 20% inflation. I mean, it was really, it was heady times. I mean, one day you'd get even at Rice University, you could get a 25% ordinary raise. It was just unbelievable, anyway, but I think I've been trying to decide if you all are optimists or if you're all sort of very worried and cautionary. And I think the main thing that I took away from the Jimmy Carter days is that the government management is always going to really mess things up. That's why we were all sitting in these stupid lines for gas. And I give Obama great credit. He had any number of chances where he could have tried to manipulate gas prices, and he just ignored it. And I'm sorry to see Biden can't quite. I thought it was all the same advisors, but I guess not. But I think I just remember Rick Smalley. Does everybody remember Mr. Buckyball? He gave a talk at Ciencia, and he said, gee, I thought there were a couple of 100 million people in the world. It's over 1 billion. This is how he started his talk 15 years ago. And every time I listen to the Greens and whatever, and the people who are anti-growth, I'm saying, we're up at 6-7 billion people. We are well beyond that. If you try to, not have genetic engineering, we're going to really be in big trouble. The only way forward is tech. And this group represents tech. And I hope you stay optimistic. The way to get out of this is to grow through it. And inflation is not evil if you manage it and sort of live with it. But if we sort of go back to 1930 and try to clamp down money supply and stuff like that, we're going to be in really big problems if we try to control things too much. That's my 10-second sort of question. I think you can imagine some questions.
So for those of you that didn't know, that was David Scott from Statistics here at Rice. So maybe that was a statement, not a question.
Could you repeat the question?
Are you an optimist or a pessimist? We're by nature optimists. Hope so.
I'm an optimist, but I guess going back to the previous question about crypto, I'm a pessimist. I guess the reason I haven't invested in it is it seems to me like land, like investing in land. But they can make more of it. So it like sort of fails in that one feature, right? It doesn't generate any return, and they can make more of it. So, the returns that have come have simply been from speculation. So, but I'm an optimist in terms of, seeing the ability of people to take technology and solve problems, right? Dexter talked earlier, about how the rudimentary technology that was in place in Wall Street, in the 70s and 80s, and we just sort of started challenging, like, why do you have to call a person down at the New York Stock Exchange floor to buy a stock, right? It makes no sense. A computer, can do this, and it's a small problem in the scheme of things. It probably doesn't change the world a whole lot, other than makes it a little bit easier for people.
I think it did change. I think it did change the world quite a bit.
It makes it easier for people to invest, right? And to implement their ideas, right? Or align their money with their hopes and aspirations for the future. So, when we start talking about long-term macroeconomic, policy decisions, it's a little bit beyond my. I sort of got the sense from my other panels. We think it'll work out,
Yeah.
but none of us are 100% certain because we're quants, and we don't want to put a certainty on something that we know we can't be certain about.
Well,
When I was a quant,
yeah.
when I was a quant,
Back in the day.
I would have answered your question as George Carlin would have answered it. He said, some say that the glass is half full. Some say the glass is half empty. I think the glass is too big, which was his way of thinking outside the box. So, we're going to have.
Translation, the glass is full.
Huh?
The glass is full because it's too big. 'Cause
The right glass would be
the
full.
right glass would be full.
Yeah. Look, we, as a global society, have some work to do. And we're being thrown little mini challenges right now in the form of Syrian refugees, Ukrainian refugees, global supply chains, blah, 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 okay? Yeah. Little
Rising
teeny
sea
ones.
levels.
Wait for climate change. Right? And 300 million climate refugees.
300 million.
Yep. So, look, there's not a technology fix to that. A new model isn't going to fix that. So we've got some work to do as a global society to tackle this. But are we going to tackle it? Yeah, well, we're going to muddle through like we do with everything else. I don't know what the answer is. We'll muddle through it. And whatever the solution won't be great, but yeah, we'll get there.
That's a good spot to end. So, yeah. So let's thank our exceptional speakers. And we're not quite through with the conference, so I'm going to turn it over to John. And